Our next speaker is Rob Klein. He's a Medicare and long-term care consultant. He is with Inertia Advisor Services Group. Rob is a leading expert in managing and controlling healthcare expenses in retirement. Today, Rob will demonstrate ways business owners can protect themselves and their families more cost-effectively now and in the future.
Thank you.
Take it away, Rob.
Normally I come with a presentation with a few slides because it's nice to see the actual numbers. But this morning, in a way, I'm glad I don't have it because this is a nice setting this way. And being able to follow Mary. Mary said a lot of things. I've never heard her presentation before. She's actually said a bunch of things that I do on the healthcare planning side and on the long-term care planning side, where you, especially when you start talking about qualified dollars. First thing, just to give you a little background, as I know Tracy spoke a little bit about me, I wear a bunch of different hats. I'm an independent financial advisor, the duly licensed firm, but after Lehman Brothers collapsed, I realized this business is heading in a terrible direction. And I said, what can I do where I can provide something to my clients that no matter what goes on in different market cycles, economic cycles, that there would be something of use. And I came across mandatory health costs. And a lot of people thought the first time that Obamacare came out that, hey, I can't believe the government actually made us buy something. Terrible. Well, I got news for you. That's not the first. Medicare is required. If you want to get your Social Security in retirement, you have to enroll in at least Medicare Part A. I don't want to get into a huge discussion about Medicare, but all I want to say is about this is that the cost of it in retirement, it's not free. And the cost is based upon your income. The greater your income is, and not all income is counted, but basically anything that's going to show up on line 8B and line 37 of your IRS 1040, which is otherwise known as your modified adjusted gross income, is going to determine how much you're going to pay. There are a few things, about 5 or 6 things that are not on there. Mary mentioned closely held businesses. Anyone here ever hear of a 401h plan? Okay, 401h, you have. 401h plan is kind of like a health savings account, but it's on your pension. So instead of being limited to a smaller amount, you can put up to 25% of your pension dollars in there. You can't move 401k dollars over, it's got to be new money. It's non-discriminatory, so it's not going to work. You'll never see GE or any other company do that. But if you're a closely held business, that's a great way to use the tax code to save for long-term, for Medicare costs later. And that's just one thing. There's a couple other things that we can discuss, but I want to talk a little bit more about long-term care and using the tax code and what business owners can do for that, and also individuals. Okay, you don't have to own a business. If you know of anyone who wants to plan for long-term care, the tax code has changed a little bit over the years that make it very advantageous to do that. And the reason why I transitioned, or I make the transition from mandatory health costs to long-term care is very simple. Mandatory health costs, all of us are going to have to pay for that. We technically have to do it now if we're under 65, but even more so if we're over 65. But the reality is Medicare does not pay for long-term care outside of your 100 days in rehab, or if you're at the unfortunate point in your life where you need hospice. Okay, it does. So you have to come up with ways and how are you going to finance that. You can self-pay, you can transfer that risk to an insurance company, okay? Or you can try to divest yourself and wind up on Medicaid, which I generally don't recommend unless if you have no other choice, because Medicaid is technically welfare. But in some cases, that may be someone's only option. So what's in there in the tax code to do this? Well, before we do that, does anyone know exactly what long-term care is? Okay. It's a word that gets thrown a lot around. When I talk to the general public about it, they typically automatically think of a cold, dark, dreary nursing home. And that's not true. Most long-term care is given in a home. And it basically means care that's going to be greater than that 100 days. You're going to need help, what they like to call the activities of daily living. What are those? You can't walk or get out of bed, you can't eat on your own, you can't get dressed, you can't bathe, you can't toilet, you're not continent, or you have issues with dementia or Alzheimer's. Those are the triggering things for long-term care. So now once you know what it is, you know that it's expensive, there's a couple other issues that you have to be realistic with yourself about is, okay, can this happen to me? And, right. I mean, we see the statistics, we know it can happen to us, but believe it or not, there's a lot of people who think they're going to live to 100 and still act as if they're 21. And, you know, we all know that that's not true. Stats tell us 70% of people will get it, will wind up with needing some sort of long-term care services. Maybe, maybe not. But again, if you've been through it with a relative, it's very costly, it's very painful emotionally, and it's not something you want to recommend people go through, but it does happen. So once you got to understand that there's a belief, number two, you have to understand what I call the logistics and the emotion aspect of it. Logistics meaning, where are you going to have your care? Is your home suitable to have it at home? Well, if you live in a multi-level home, that may not be the best place to take a wheelchair down the stairs or a walker. You have a lot of people that might want to stay there. Well, there's a reason why in some parts of the country, those one-level properties are very, very much desirable now. Used to be people wanted to knock them down and build them with mansions. Now you have people looking for the ranch or the rambler because they need everything on one level. Okay, so if you have that, great. If not, all right, where am I going to go? Am I going to go with my kids? Do I even want to go with my kids? Do I trust my kids to take care of my care? And then the emotional aspect of it is, all right, I mean, it's great. My wife's close to my age. We've been with each other for many years. We love each other. She'll take care of me. Great. Maybe she can. But what about the emotional impact on her? You might need you might need a little bit of break for that. And the last part of it is paying for it. You know, Tracy likes to say, well, what happens when you get sick? You've done a great job of putting away money, but now what happens when you get sick? I like to take that one step further. In the event you need long-term care, what's the first asset that gets liquidated? Do you sell your home? Okay, well, where's your spouse going to live? Do you liquidate your IRA? What's the tax cost in doing that? Do you just cash out of all your investments? There may be a tax cost in doing that. Do you have enough cash? So these are things that you want to ask yourself. Or did you purchase some sort of third-party risk transfer tool like insurance? So once you get through all that, then you can look and say, okay, well, what are some tax-wise ways of doing it? Well, the traditional long-term care insurance, which a lot of people have known for years, not that popular now for a variety of reasons, is because there's not that many carriers left in the business. I read something in Forbes the other day that there is a tremendous decline in it. And it's also very difficult. There's just not many carriers there. They service their existing business. For business owners, they have something that's still around, but again, good luck trying to find a company that does this. If you were a C corporation, they would let you, the corporation could purchase the insurance, and a lot of business owners would prepay over 10 years or pay to age 65 for themselves, their spouse, maybe some key people. But again, the carriers that offer that are just not around. Okay, so that's not there. There's something else for S corps, which I don't want to get into, but that's a really interesting thing that can be done. But even if you're an individual, there's still tax benefits available. States, and it varies from state to state what they allow you to do if your state has income tax to deduct. On the federal level, if you itemize your taxes depending upon your age, you would be able to do that. Although to make Obamacare more affordable in the eyes of the CBO, they adjusted, as many people know who itemize, and you have medical expenses, it went from 7.5% of your adjusted gross income to 10%. Some people won't make it over that hump. But if you do, it's in there to deduct premiums. The other interesting thing is that a few times government does do things right, and they've changed certain things in the tax code that are very advantageous for long-term care planning. First one is in 2006 when they changed the Pension Protection Act. Actually, not changed, they installed the Pension Protection Act, or shall we say voted on it, made it law. Buried in there is something very interesting that doesn't really have a whole heck of a lot to do with pensions per se, and that is that if you have an annuity that you buy with after-tax dollars, the distributions from that annuity, which would normally be taxable as ordinary income up until your cost basis, are now tax-free if you use them for long-term care. That is tremendous. Because if you have someone, it could be yourself or a relative that maybe bought an annuity at a bank many years ago and has accumulated some dollars in there, and they may say, hey, well, that's what I'll use for a rainy day, or if I need long-term care, I'll liquidate that. It's a tax cost to get the money out of there. Not if it's a Pension Protection Act qualified annuity. That is great. And if you don't use it for long-term care, it follows the regular rules of an annuity, you know, the same tax rules as you use it for savings and retirement, same tax rules if you pass it on to heirs. Becomes a very, very useful tool. Other things in the tax code, the tax code allows certain permanent life insurance policies where you're able to convert the death benefit to long-term care. To me, that is a tremendous opportunity, because if you have situations where someone no longer needs the death benefit that much, but has a cash value in the policy, now you've used a policy that can wind up doing not just work as a death benefit, but it could also cover for long-term care. So a couple of different nuances. I'm not going to get into them now. I could do it privately, but there's nuances between what the rider is, if it's an actual long-term care rider or if it's a chronic illness rider. Believe it or not, they're in different parts of the tax code, and they actually function differently with how much money you're able to get out if you need care. But the point is that they're there. Another interesting thing, and this is why I'm glad I followed after Mary, she mentioned something of what to do on distributions and how they're taxed. Nobody, I shouldn't say nobody, but few people like to pay attention to the fact until it's too late. Think, great, government let me put away all this money, I built up all this stuff. Well, guess what? It's renting space on your letterhead. It has to come out by a certain period of time, and it's expensive. And it could actually move you into another tax bracket where you could wind up paying more for Medicare. That's why I say how these things move from one to another, meaning it's Medicare and long-term care planning actually go together. Well, one of the things that you can do is, if your state allows it, New York of course doesn't, New Jersey does, you could take do what's called a trustee-to-trustee transfer on a portion of your retirement dollars, move it over to an IRA that's funded with a long-term care annuity, and then do a distribution, and you could do it even as long over 20 years, and purchase a life policy with long-term care. Now, why on earth would somebody do it? Sometimes when you mention it to an accountant, they go, oh my God, you're paying some more in taxes, you should keep deferring. Defer to what? You're just inflating the number you have to take out later. This would allow you to satisfy, if you run the numbers correctly, you could start working on your RMD. It could count towards your RMDs, your required minimum distributions, when you're over 70.5. But what it also does is it shrinks the amount of money later that you will have to take out for required minimum distributions. You plan for long-term care, and those dollars, because you're paying taxes on them now, those dollars now become tax-free when used for long-term care or as a death benefit. It's a wonderful strategy to use. Other strategies to use tax-wise with respect to long-term care, so I mentioned the Pension Protection Act, I mentioned this, oh, and by the way, and with respect to long-term care, you could put 2 lives on there. So even though it's technically an individual retirement arrangement or an individual retirement account, for the purposes of long-term care, you could actually put 2 lives. Not all states do that. Like, for instance, Pennsylvania doesn't. Ran into that situation there. Connecticut does, New Jersey does, New York, forget about, don't even, unless if you have, a reason to be outside the state, New York, somebody owns property, some of the carriers will still allow it, as long as you understand that that contract comes from a different state. New York won't help you if you have a beef with them, with the insurer. But as long as your client's cool with that, and the client's other advisors are, that is a possibility. But for the most part, you're looking for out of New York clients for that. So that's a great concept. Another thing too, again, I mentioned if somebody has a lot of cash value in a life policy, they could withdraw that to pay for long-term care. But the problem is, if they take too much out of the policy, that becomes a taxable event. Okay, you can do withdrawals out of the life policy, and technically could structure them as a loan, but those won't be taxable. But if you wind up accidentally surrendering the policy, you could have a problem. Now, $250,000 of cash value inside a policy will only go so far with long-term care. But what if you took that $250,000 in the policy and did what's called a 1035 exchange, which is not taxable, and did a policy with long-term care benefits in it? That $250,000 could produce over $600,000 of long-term care benefits. Now you don't run into the risk of accidentally collapsing the policy and creating a tax problem. And that's, pretty much, that's the shortened version. There's a lot more, nuts and bolts to what I talked about, and there's a lot of, the nice thing is there's a lot of custom case design that you can do depending upon what's important to the client. And that's pretty much all I have to say, and if you have any questions, please see me afterwards.
You feel that, excuse me, you feel that the life insurance with the long-term care rider is the way to go?
For most people, I mean, if you don't mind, if money's not an object, and you can find a carrier that's well rated and that's supposedly, going to be in the business, then by all means buy a traditional long-term care policy, because the benefit payout probably be the richest benefits that you can get. The problem is that there's not many out there, so the cost is expensive, and they cannot guarantee what your premiums are going to be.
Right.
So somebody that can afford something in 2017 may not be able to in 2025.
They're priced at when they first came out.
That's one reason. They also use gender neutral rates, and not enough people buy it. What I mean by gender neutral is when it comes to life insurance, it's less expensive to insure a woman because she statistically actuarially is going to live longer than a guy. When it comes to long-term care insurance, women are actually more costly because they tend to use more of it and live longer in needing care. It's like they'd say, like, well, a woman might spend 3 years in a nursing home, while a guy may be less than a year, or upwards max of a year and a half. How can you price them the same? And that's what hurt companies like Genworth and a few others. John Hank, a lot of them just got out of the business. They just service what's there, and they've moved on. And
If you buy a life policy that has this long-term care rider, is the underwriting different?
so it depends on the carrier. Some of them are stricter, and some of them are not. It's gonna depend on what's driving the policy. See, if it's one that has like a chronic illness rider, it's really more of a life insurance underwriting, and in the cash flow, that generally speaking, that's going to be a little more robust. The underwriting for long-term care on the hybrids is not that difficult. I know on the annuities, like in New Jersey allows a hybrid annuity, underwriting's a piece of cake. They approve most things that come in front of them, at least at standard, and they still do a lot on preferred. And what's the difference in that case on the annuity between standard and preferred is the leverage factor. If you get standard, it's 2 times. So if you have a $200,000 annuity, it's $400,000 available for long-term care. Can't walk away with $400,000, just they'll let you use $400,000 in long-term care, or it's going to be $600,000 if you're preferred.
Good.
But the underwriting's a little bit easier. And also keep in mind, a true policy that's designed for long-term care riders, the cash value is not going to be the driving part. So if you're looking for cash growth, like Mary mentioned a little bit of that in her part, if the client wants to see that grow, you're not going to see that with a long-term care rider when it's not built for that. It's built
In
for
the
care.
life insurance with the long-term care rider, is it the cash value that becomes the long-term care or the death benefit?
Death
Or both?
benefit. A little bit of both. It's more of the death benefit that they're working on. So, thank you.